All right, so we are looking at a crude depiction of a open high-low close bar, and this is a generic little pattern that I use to teach my PO3. And basically PO3 is accumulation, manipulation, and distribution, and how that is presented in a daily range. Now, this formation is not specific to only a daily chart. It's every time frame. So the things that I'm teaching you here, don't think just in terms of the daily range, because you can use it as a session range. Okay, the same premise that I'm going to be referring to here can be applied to just what occurs between 2 o'clock in the morning and 5 o'clock in the morning New York time for London. And equally effective, it could be done for the time window between 7 o'clock in the morning and 10 a.m. New York time. Go higher. And I'll cover a little bit of that in this presentation. But if we're looking at a daily range and we anticipate it being bullish, it does not need to have the open, the low, the high, and an up close for me to have a bullish bias. In other words, I don't care where that close price is. I just need to know, is it more likely to have the range expand to the upside or the downside from the opening price? The very truths of the marketplace. So with the assumption that we are bullish, okay, the idea that, say, this is the euro dollar, and this is a daily range that you anticipate being bullish for that particular day. I'll cover in a moment how those things could be derived. Doesn't mean it's 100%. My daily bias is not 100%. If I get something initially wrong about my bias early in the day, I may have something that constitutes a reversal of my analysis, or I have something that completely negates the idea and I move to the sidelines. So it's important to know there must be flexibility in your daily bias routine. Okay, so also daily bias generally does not flip-flop back and forth, bullish, bullish, down, down, bullish, bullish, down, down, bullish. It doesn't do anything like that. It's predominantly, when the market is bullish, we're looking for expansion on the upside. So trades that allow a move from the opening price higher and not requiring the close to be higher than the open. Of my reversal market profile, but that's beyond the scope here. But the architecture of the daily range, the first and most important thing is, if we're bullish or bearish, is that opening price. So the question is what is the opening price? You can go and simply use the opening price at midnight New York time. Okay, whatever that opening price is for the market you're trading, that is the opening price to me. Okay, that's an opening price that I could use with this idea here. If I'm bullish, I want to be buying near, or in the best case scenario, below that opening price, with the expectation that I'm buying usually the low of the day or very close to it. Or if I miss it, okay, say I was a little ambitious and I had a limit order that was just beyond the scope of what the daily range reached down for that particular day, then I have to decide whether or not I'm going to participate and trade something closer to the opening price or just above it, which is not like breaking a rule or anything. It just means that it's better to be trading at the opening price or below it when bullish. And if we're bearish, we want to be trading short at or above the opening price. And that's your highest probability, low risk scenario. You can't get any better than that. And if you study daily ranges when the market's bullish and study where that opening price is at midnight, it doesn't happen all the time. It's not an everyday bias filter. Like, it doesn't give you an everyday thing. It just means that you go into your day with that expectation that if you're bullish, you want to be buying at or very near the opening price or below it. So we're going to use this idea here. Everything I'm saying, you just reverse it when it's a potential bearish scenario. So the opening price is the most important, okay? And it's, again, the opening price at midnight. How do you arrive at that? What is the opening price on your 15-minute chart? There you go. So draw that out in time, usually extend it out to around 11 o'clock in the morning New York time. Now, why that time of the day? It's smack dab in the middle of London close. London close kill zone for me is 10 o'clock in the morning to noon New York time. Now, it can go a little bit beyond noon and sometimes go into 1 o'clock in the afternoon, but by and far and large, 10 o'clock in the morning to noon New York time, that's London close kill zone as I define it. So if you just use the 1 hour mark right in between the two, that's 11 o'clock. Draw that opening price out to that period every single day and study that. Makes this stuff work. It's not just watching a video, binge watching. So getting back to the opening price, this price here is the opening at midnight New York time. If we're bullish, we don't expect a lot of price action on the downside. It can, but if it does go below it, during the London session, we're generally looking for the low of the day to form. If, for whatever reason, there's very little movement below the opening price at midnight during London, and it starts to move up, but doesn't really expand too far, or doesn't move a lot in terms of pips. Now, what is that? That's kind of like open for interpretation. What is not moving a lot, Michael? Say it moves around 30 pips, maybe 35 pips for the day, and it enters New York. Generally, it could come back down and travel below the opening price during the New York session, especially if there's high impact or medium impact news. They may use that as a guise to take it down below the opening price and run the initial low of the day. And then you'll have what I mentioned earlier in passing, which is a market reversal profile for intraday. And then you would catch the low of the day that way. And then you would expect the range to expand on the upside. Again, not requiring that close to be higher than the opening price. So the high of the day is what we're really targeting. We're targeting that. We have to have some rule-based idea to have some realistic, solid, sound basis. I'm trying to find all the salient adjectives to describe what you're doing with the high of the day. And it could be a pivot point if you like to use pivot points. It could be an old high if you like support and resistance, or an old low. Same thing with support and resistance. And it may be a Fibonacci level. It may be a specific Fibonacci extension. It could be an intra-week high, something to that effect. But you need to be aiming for something, okay? And whatever that is, it needs to be predetermined. You can't just watch price go throughout the day and say, well, I wonder where it's going to reach for. You need to know what it is. And average daily range on the last 5 days is another general rule of thumb where you could look for a target for the intraday. It does not mean, but I do have tools that will allow you to get to the high and low of the day. But you won't know how to do that even if I sit down and show you. It takes time to practice. As you'll see in the later portions of this description and teaching, it's not always as easy as open, down, rally, close on the high. And this is what you're all expecting, especially those that watch all my YouTube videos. You think this is how it's always going to pan out. And then the first day you see this not form when you think it's bullish, it throws you into like a short circuit. You're like, this doesn't work. It's failing. They're changing the algorithm. They're going after ICT now. They're changing it because everybody knows how to do it now. That's not what's going on. You're just operating in a particular day that may require consolidation or retracement. Then this type of day will form. Okay, but again, the closing price is not that big of a deal. So on the buy days, or when it's bullish, and our bias is bullish, we're focusing on the open and the high. Okay, those two things are critical. The less forgiving is the low, because you don't necessarily need to be trading at the low of the day. That's the highest form of analysis. If you're bullish and you're buying the low of the day, or very close to the low of the day, what is that? Within 5 pips. And is that reasonable? Is it realistic? Absolutely. Is it realistic for you to expect that you'll do this, the first few times that you sit down, or in the first couple months of learning it? No, because you're going to be fearful. You're going to be afraid. And you may see this opening price and it may dive down 25, 30 pips, and it might do it quickly. And you'll be scared. You'll be like a deer in headlights. You'll second guess yourself and you won't trigger it. You won't put a limit order in because you want to get in at the market after it starts moving in your favor. And these are all the things that are normal for you to develop as a trader. But you have to go in and tackle these fearful situations and do it with a principle-based approach. Whatever it is, the idea is that you need to be deriving what that bias is based on whatever the high is that you're aiming for. And it's going to be rooted on something beyond that one single daily candle. And I'll talk about that next. But the close is the least of our concern. We don't care where that closing price is. Because what is the closing price? That's way into late New York time. I'm not trying to trade that time of day. So what's the closing price for me? Whatever the opening price is at noon. 15-minute candle, the opening price when the 15-minute candle opens during the noon hour in New York, there's your closing price. And do all your studies with that mindset. The opening price at midnight and the opening price at noon. There's your beginning and end. There's your bookends. What does price do between those specific times? If you study that, you'll see that usually is going to be the perfect encapsulation of the lines portion of the daily range. Now, you may get some kind of a little squiggly move a little earlier, during the Asian session previous day, which will be the new trading day for some of you. But I look at things from a New York time. Okay, so it's not a new day to me until we get into midnight New York time. Then it's a new day. And it may sound, again, arrogant and self-centered as an American, but that's just how these algorithms run. They run on New York time. You can argue about it all you want, but everything runs on New York time. So the idea is you have to know what the architecture is of the daily range, and it's based on these four components. The opening price, most important, whether you're bullish or bearish. The high, when you're bullish, you're aiming for something, okay? And I'll talk about that in a minute. The targeting of that high starts with an ideal area in the market where you're trying to buy, okay? Some kind of a low. Now, the low of the day, it's not important for you to try to get in that every single time. You have time, and you're going to have to grow into that, and I don't ever sugarcoat it. But you don't need that to find an opportunity in the daily range bias. So usually what happens is between the opening price and the closing price, this part of the body of the candle, it's usually 2 o'clock in the morning, New York time, to around 10 o'clock in the morning, New York time. So that around 8-hour period of time is usually the body of the candle. That's the lines portion of the range. That in itself is a huge milestone. Once you study that and see it for what it is, it's the truth. You won't be afraid of getting into another trade opportunity if you miss your ideal entry, if you understand that. You also will grow to welcome New York session trading, because New York session trading usually is somewhere above that opening price, unless it goes down and dives below the opening price and runs the initial low of the day out, like I mentioned earlier. And that doesn't happen a lot. And even if that does happen, and you say you get stopped out, if your bias is still bullish, you got to anticipate that as a potentially, you got stopped out. You did something wrong. Don't beat yourself up about it, and go in and look for another opportunity at that opening price or close to it, because New York session will do that. If everything's remaining bullish, it will still do that. And then you can ride that expansion in the New York session into that 10 o'clock to noon hour where we close. Okay. Your candles on your platforms and on your brokerage accounts, they're not going to paint the daily range like this with these time parameters. That's why you have to think about things a little differently, and you have to put your daily dividers in for your perception of the daily range. That means midnight to noon, but has been taught in other lessons. So what are we looking for if we're bullish and we're aiming for this high? Okay, what high price are we looking for? it's going to be a draw on liquidity. Now, what is that? Okay, it is the most important thing in trading. Why should a market go up? Or why should a market go down? It's going to be reaching for something, okay? And that something is liquidity. Liquidity is just a term that's used to understand orders that are in the marketplace that are waiting to be paired up with a counterparty. And what do I mean by that? If the market is likely to go higher, and that means our bias would be underlyingly bullish. That bullish bias suggests to us as a analyst that we think the daily range is going to expand over the hours I've outlined in this teaching. If it rallies up to an old high and just above it, what would be resting above that old high? Buy stops. Why would an old high have buy stops above it? Because there's traders that are short from that old price high, and their orders to protect that short are buy stops. So if the market is down here and opens below that old high somewhere back here, and I'm speaking hypothetically, but if you've been following this channel for any length of time, you pretty much know what I'm referring to. It's going to be running for an old high. It might be old equal highs, relative equal highs, or one singular swing high. And above that is going to be buy side liquidity or buy stops. So the liquidity that's being attacked is buy side liquidity. So that's the draw on price. It's going to go up there because it needs to go there. It needs to go to a level where there's going to be a exchange. Anyone that's buying down here, they have to have a way of getting out of it. So what do they have to do to get out of their long position? They have to sell it. So if they bought it, let's say, perfect example, we bought below the opening price at some really fancy round number, and we held it all day long, and it ran above an old high. Those buy side liquidity orders are going to be waiting to be tripped as a market order. If the market trades there, those buy stops become market orders to buy at the marketplace, which is perfect for the smart money traders that are long down here. They're looking to sell it. So they're pairing it with a pool of liquidity of traders that have an interest in buying at a higher price. Why? Because they've been short and they want to be out if it goes above their specific price level. And everyone knows trailing stop losses are a cancer on retail traders because they don't know how to effectively manage their position. So there's always going to be a plethora of buy stops above previous day's highs or below previous day's lows in the form of sell side liquidity. So as a short-term day trader, you can capitalize on that and use it as your high or where you think the market's going to go. Now, let's get back to this point about the close. Just like we don't care about where the closing price is, we're not trying to forecast the closing price exactly at the opening price at noon, New York time. That's not what we're trying to do. Not something I'm laying before you as a personal challenge. What you're trying to do is find something that it's going to target. And here's the rub. It might go beyond your target. And that's a lesson in itself. You're going to learn a whole lot about yourself if you get into a trade and you get out with a reasonable or respectable pip haul. Say you take 100 pips out of the day. It's not likely, but let's say you did take 100 pips out of the day. But it moves 180 pips. Are you going to be mad? Sure you will. You're going to be upset. You can say, no, I would be happy with 100 pips. No, you won't. Okay? I can tell you, I don't feel that way. And I've been doing this a long time. So you're never right in this industry. You're never going to be the perfect trader. It's never going to happen. So that's why you have to determine in static terms what the high is that you're aiming for. And from where you're entering and where you're aiming for, that's your trade. But the draw of liquidity is where the market's likely to go. So that's what you're aiming for. In this case, when we're bullish, that's the high. That's that price that we're aiming for. So we're using the draw on liquidity that is an old high. Now that old high might be in the form, like I said, of an old low that we traded through, and now it may come back up to that as an upside objective. I don't personally like to look at trades like that because everybody thinks that way in retail. It's support resistance and support broken turns resistance. And sometimes, but not all the time. So that high, just think of it as relative equal highs. Okay, and if that's what you're framing on a 15-minute chart or an hourly chart or 4-hour chart for your target for the high, that's your draw on liquidity. And then once you understand that, then you're going to be utilizing institutional order flow. And we'll talk a little bit about that in our next slide. So the draw on liquidity, this is the euro dollar. And they're just trying to make a YouTube channel and look smart. But the idea of the draw on liquidity is rooted on a higher time frame chart. And one of the best ways you can do that is use a weekly chart. Now the weekly chart, in this case here, the euro, we've gone from trading up here in the highs of 2018 all the way down to the March time period or so of this year in 2020. And we started to rally up from there. The range that it was working within is this high to this low. Now, right away, you may not have seen anything down here that would be bullish, and we're not going to get into that. When you look at a weekly chart, the only thing you need to be worrying about is the next candle, like say you're looking at it on a Saturday, and on Saturday when the markets are not trading, you want to look at your weekly chart and say, okay, what is the likelihood of the next candle on the weekly chart expanding higher or expanding lower? That's the first step, folks. That's all you need to worry about initially. If you can't determine what the next weekly candle is going to reach for, then you have to sit on your hands and wait until Monday starts trading. And then usually wait until Monday's done. What has it done on Monday? Has it given you any more insight or clues as to what it's trying to reach for? If the weekly range is going to be an expansion on the upside, I'm willing to let Monday go. And in Mondays in my trading have had sometimes really big blast off days, and I missed a big portion of the weekly range. I don't care. I'm not beating myself up because I know what I do repeats. And you'll learn that too. But you won't feel that comfortable if you start by listening to the rules I give you and you see a big Monday. You're like, oh, what does ICT know? You missed that move. Yeah, I probably did. But I'm also finding 2 or 3 more really good setups in intra week that work within that same idea of the weekly range expanding on the upside, or in a converse sense, when it's bearish, I could be looking for something that's going lower intra week and not requiring participation on a Monday. Okay, so what we're looking at here is a order block right here. Now I identified the high and the low so that we can clearly see it, and the high of the order block and the low of the order block, that is the full range, or what we're going to be using as the draw on liquidity. So before this weekly range started, and we're looking at December 18th is Friday. Yeah, 18th, 2020. So at the time of this recording, we only have tomorrow for the end of the week, and then there's no more trading. We stop trading for the week. So we don't know what this weekly range is going to do with 100% assurity. We don't know that. So the probabilities are, is it likely to go higher or lower? And the fact that we have traded from this consolidation, we started to move out of it, and look how many weeks we've had where it's been one big range, another big range, a small little indecisive range last week, and then we have a nice big expansion on the weekly range here as it trades right up into that bearish order block. So every single one of these weeks had opportunity, even last week with the indecisiveness that the weekly range showed. But here's the wonderful thing, and this is where you write things down. Every time we move from consolidation and start to have an expansion phase, you need to start considering this factor right here. Where is the draw on liquidity? And if you get caught up in a week that is indecisive, don't think that it's topping. It doesn't mean that it's topping. It just means that we're in another smaller period of consolidation. So what's being shown here on the weekly chart is occurring here on the 4 hour and the 1 hour of this individual weekly range right there. But when this happens and we're bullish, if we have an indecisive candle or if we have a down candle, then we have a increased probability that we're going to have a large range expansion on the upside if we are still underlyingly bullish. And the market trades right up into that bearish order block right there. Okay. So with these levels, and we're going to look at a daily chart. And we can start seeing, this is the new trading session. And this is Thursday's trading, Wednesday, Tuesday, and Monday. So we had a week that had relatively every single day it was a buying opportunity. But not every single day had a obvious low risk buy. But the bias was what? Bullish each day. Doesn't mean bullish daily bias means everyday trading. It doesn't mean a bullish bias going in every day is an everyday opportunity to be a buyer or that you're plunging in. That's why you are losing, because you're thinking that everything has to be cast in stone, and it's not. It's not. And that's the hardest thing for me to beat through the barrier of a new trader in development, is that they think they have to be able to know how to do this every single day. Able to know how to do this every single day. And there are, and this is probably going to be shocking to some of you, I don't know sometimes. I have to wait. And it may require me waiting through an entire London session. But then I can see what it's likely to do for the New York session. Or I may see something in London, go in, lose, and think I got it figured out in New York, and then lose again. And then I have to stop because I have misread it and I am wrong. I don't want to go in there and throw good money after bad just to know that I'm really, really wrong. So that's the reason why we have to have rules. Okay, so if the rules aren't in place and we don't know what they are, then you should not be surprised when the results are lackluster or less than stellar. So we're looking only for the anticipation of the ranges to expand until we get to that red line. Okay, now the red line is just a target. It doesn't mean it's going to go there in reverse. It can, and this is what sometimes people misinterpret. Oh, here comes the plan B. It's not plan B. That wouldn't be my trade. I would never look at that and sell short. I would look at that as a run up into that. And once it gets there, then I'm done and I move to the sidelines. But I'm being honest with you. So if I tell you that this order block would be a draw on liquidity, it's because it's an area where it needs to potentially trade back up into, because I don't believe in support and resistance in the classical sense, but that up close candle in that old consolidation back on that weekly chart is enough for me to use as a target. Now it might trade even through that and go to 125s. Okay, that doesn't mean anything to me. It just means that what's the next likely upside objective, and I'm going to aim for that. Is there enough range from where I could potentially try to enter at and that high that I'm aiming for? We're about to see some of that price action. But you want to be looking for where the market's going to draw to, because that's the most important thing. That's the basis of why the market's reaching for it. The markets move to go to liquidity, or it goes to an area to rebalance. So there was an imbalance or an inefficiency in price action. It will go to those two primary drivers for price movement. The third is a central bank repricing. And then you have nothing that usually can forecast that. It's there and you got crushed. Okay. That's the risk. Every single time you trade these markets, you are risking a unannounced, something happens in the world, somebody dies, there's a war that breaks out, something to that effect where it's an act of God or something unexpected happens, and then the central bank prices in that move or that event. So the daily chart, each day had a range expansion. And again, we're not trying to forecast where the closing price is. We're just looking for that expansion in one direction over another, where it's one-sidedness. That's what we're focusing on. That to me is bias. It's not where does the close finish the day in relative terms to the opening price. That to me, I could care less about that, because you can make a lot of pips in environments where, even in this kind of mess here, these indecisive candles here, there's opportunities in here to be a buyer, and you can find trades in that. It's not always just down, 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 down. In these days here, you could still have a bullish bias and get scalps. It doesn't, for a new student or a new trader that's trying to learn how to do this, when you see these down moves like that, it doesn't feel like that's possible. Like, who's buying in that? A high frequency trader, or a scalper, or an intraday trader. They don't have to be in going short, and just because the daily range closes lower than the opening doesn't in any way force the idea that that's the only way to make money. It just means that it provides you as the analyst and potential trader to have a framework to work within that data, that daily range. How are you going to interpret what the price action's doing on your chart? How do you see that? Is there opportunity, or is there a lack of opportunity? So let's go into the hourly chart, and you can see this is the hourly chart for this particular trading week for Euro. And you can see ahead of FOMC, which was occurring on 2 p.m. here on Wednesday, and prior to that we had consolidation. You see that? Consolidation, which was that part of that larger daily consolidation phase. So it wasn't really trying to do anything yet. But this level up here was still in play. That's what we would be looking for what? The draw on liquidity, which is what? The high of the day that we're aiming for, which is what we're trying to get to after buying below the opening price or very close to it. You see how we're starting to flesh out bias? Now, again, every single day, here's Monday's trading, indecisive. Okay, here's midnight New York time. So the opening price is down here. It doesn't really drop down until there, which is later in the day. And it goes up a little bit and consolidates, and it goes one more time, drops. Now in here, we have the opening price, and it does drop below that. And it drops below a short-term low here. And that right there might be something to look at with a closer eye in terms of the dollar index. Is there something here that shows there's a reason to be anticipating this as a buy? I'll leave that for your study. But then the market goes in consolidation again. And then the next day, on the day of FOMC, we have the opening price. It drops down initially and then rallies big. You see that? But then what happens? As we get closer and closer to the FOMC, when FOMC comes out, they use that as a catalyst to drive down below sell side liquidity. But they leave these here. Okay, you see that? Not every relative equal low is ripe for the taking. Folks are really warming up to that idea, and they're making courses now around it. But this isn't always the reason. You have to have a narrative. And the narrative is, we've already shown a willingness to go higher, and this run down here is just to upset anyone that's already long so they don't get a chance to participate in the upside after FOMC comes out. So when you see this move down here, as a developing student or a neophyte trader, you'll be looking at that and be afraid, and you'll cancel many times or abandon your bias. I don't, and my students don't. We don't do that. We anticipate this as likely manipulation. The narrative is the market's consolidating. They have a willingness to go higher, but they're coming back down to knock out individuals that were already a participant buying in here, and they are on the market's correct side now, but they want to knock them out. That's why the algorithm does that. Okay, this is not a whole bunch of people selling. It's not a whole group of buyers no longer interested in buying, so therefore then the market drops down. This is all engineered. And that's the part that gets under people's skin, because they don't like the sound of that. They like to trust their buying and selling pressure ideas and buying and supply and demand factors. The Forex is not based on that. It's all 100% controlled. So when they take the liquidity out and those traders that are now long get knocked out, they're not going to want to go back in when it starts to go up. They're going to be afraid. Why? Because they refer back to that bias that they had has caused a painful event. They got stopped out. So like a deer in headlights, they're going to watch that Mack truck come right at them. And if you've ever traded with live funds, you know exactly what I'm talking about. You have had this happen to you, maybe not on FOMC, but other instances where you got stopped out in the marketplace. It's many times like a non-farm payroll. So when non-farm payroll Fridays come, we anticipate some wonky price action. But it's beneficial to know what it is, because many times it sets the stage for the opposite direction of what we see on non-farm payroll. That's why daily bias is really not important on that day. But I like it to use it as kind of like a Judas swing for the month. So while we don't generally like to trade during or ahead of FOMC, we get the information that it provides us. And trading down here, it went to a level and into an area where we have already mapped out your model. But when we look at the price action after it creates this manipulation, we look at this right here, institutional order flow. Now notice how every single day it's been consolidation, a little weird in terms of its delivery. It's been consolidating, and we get this first pump up here. Then it drives down. Okay, what did it do there? It took buy stops out initially, then ran for the sell stops. Right here is one of those moments when you want to write down in your notes, because if you do not do this, you are missing out on the golden teaching of this lesson. What's the bias? I told you, bullish. Okay, if it's been bullish and we see a consolidation and it runs what side of the marketplace first? The buy side. So it's doing what? Taking those traders out that were short. They're stopped out. It's taking traders in that want to buy on a breakout, and then attacking what? Their sell stop. So what is the narrative here? Consolidation with underlying bullish bias. FOMC is the high impact news event for Euro for the week. The market breaks out of the consolidation, takes buy side out, trips traders long, then attacks them. If it does this on FOMC, or if it does something like this at any medium or high impact news event, you have a trade. You can be a buyer down here, or you wait for any type of small little retracement as it starts to move back up. Right in here, small little retracement in here. As it's pulling back, remember, this line should be on your chart, or at least in your notes saying, okay, this is where I'm aiming for. So anytime you have down candles, think about this right here, institutional order flow. If you're bullish and we had some type of manipulation, a stop run, the market is now allowed to move higher and reprice higher. It won't always give you a run, optimal trade entry, buy more, run, optimal trade entry, buy more. It won't do that. When we're close to a higher time frame target, in this case, you're going to see less pullbacks, because it's just going to keep repricing until it gets to the objective. And again, I'm not trying to frame the idea that this is the high or top of the marketplace for Euro. I'm just saying that this is something that would finish the idea for me for the week, and I wouldn't try to do anything on a Friday to trade. Let's put it that way. Now, if this was trading here on Wednesday, and say this was like Wednesday, New York, I would still look to see if it had more room to go up for the week, but I wouldn't be so overwhelmingly, bullish to allow more risk, or I wouldn't use my maximum risk. I would use 1/4 of what I would normally risk because of the time element. I stopped saying that because everyone thinks, like at the beginning slide on this presentation, everyone thinks that if you're bullish, it should be open, down, buy, up, close, and close on the high. And it isn't going to always be like that. The market structure that's in play, which is what we have been contending with all through here, is all on a larger term consolidation on a higher time frame on the daily chart. So on the hourly, you can really see it's clearly defined as a consolidation. And then you have this. So it shows you that yes, it's time. What's it time for? It's going to run higher. But what is it doing? It takes the retail traders short out and puts them in long, then raids them. So who's in the marketplace now? No one. Not retail. Now, I'm not saying, some of you are going to be like, oh, I was in this trade. What are you talking about? What I'm saying is this event here takes into account near-term liquidity. So the open float above these highs here, they attack that for two reasons. Neutralize shorts, engineer new entries on a breakout with buy stops. So traders that want to buy when it breaks above here, because they may have a bullish bias too. And if it goes up there, they think it's going to keep on going. Well, the algorithm has something for them too. It runs up, puts the shorts out, and puts the longs in, then attacks them. Why does it do that? Think about it. Why would it want to do that? Well, I'm trying not to personify the algorithm, but the logic behind it is the shorts is not going to make any money. Okay, shorts aren't going to make any money. So that's just they're just a casualty of war. The buy side liquidity, they want to set what in motion? They want to put traders in long. Why? Because that's going to engineer new sellers below the market at this time. So where are they going to look for that? Below here. So what's going to be below here? Once this move happened, sell side liquidity is going to immediately enter the marketplace where it wasn't there before. Because it ran out, it took the buy side liquidity out here. Now, once it does that, the algorithm is designed to go back down here because of the mindset of traders. They're going to be buying all this. They're going to chase it. And when you buy something, how do you protect that position? You put a sell stop in. Okay, so where's the sell stop going to go? Right below here. Okay, great. When the market trades down there, what does that facilitate for the smart money trader? They can buy those sell stops. So those sellers are being paired up with more informed traders. So they're buying at the low of the day during FOMC, scooping up that and rallying up. And notice how every time we have down close candles, like all this is 1, 2, 3 down close candles consecutively. So what happens is the market trades above it here and then works back down into it. That's working in an order block. So this is a buying opportunity. Rallies up. Here's a down close candle right there. It's small, but what would you expect after the down close candle? Range expansion on the upside. Down close candles, range expansion. Down close candle, range expansion. Down close candle, range expansion. Down close candle, up candle. Down close candle, up candle. And now we're at the objective of the order block. That's institutional order flow. In instances where you're bullish, okay, anytime you see a down close candle, that's an opportunity to get ready because we're going to see another range expansion on the upside. That's institutional order flow. Now, that's not everything about institutional order flow, but it's how you watch the tape. You don't look at down moves and grow disenchanted or impatient thinking I'm wrong or second guess yourself. You anticipate the next drive higher in the candles that form after these close on the downside, like these little down black candles. The next candles in my chart should be green. And every time you start seeing that, okay, it's confirming that you're on side. That means you're on the right side of the marketplace. Do not be fearful of down close candles or consolidation. That's the normal ebb and flow of the marketplace. Communicate the same way. Moving into the 15-minute time frame to close this up, you can see again, nice clean levels, punches down on FOMC, rallies back up, trades back down into the order block relative to the hourly chart. You see that here. Rallies up again, trades back down into what? This down close candle, which is a bullish order block there. Rallies up, down close candles, green. Down close candles, green. A little bit of consolidation in here. And another leg up each time. But every single time you see down close candles, you as a retail trader or a neophyte, that is normal for you to feel that way. You want every candle to be going in your direction as a new trader. And you don't like the uncomfortable feeling of when it's pausing or having a little bit of retracement. You lose your mind over that. And I also one, it was madness. The only way you're going to learn how to trust daily bias and know when it's favorable is by understanding the economic calendar, market structure, and understanding institutional order flow. The institutional order flow is the last thing in this list, but this right here is assuming that you know what this is, the draw on liquidity. And that's assuming you know how to find a high when you're bullish, and knowing that you're going to be buying at or just below the opening price or near it in New York. And that's going to give you the architecture of the daily range that you can trust. Extremely greedy, and they don't want you in their playground. You're not supposed to be here. So as a reminder, just letting you know, daily bias is possible, but daily bias is not everyday bias. Not in the sense that it's going to pan out every single day the same way you want it to. But if you are looking at a higher time frame chart and you're trying to predict the more upside or the more downside on the weekly range that's about to form, if you spend time with trying to do that, and sometimes even submitting to Monday's trading and let Monday tell you what it's likely to do, and go in there and start looking for 15-minute chart highs and lows and hourly highs and lows, and you'll see what it's going to most likely run to. And does that fit your expectation for the weekly range? Is it likely to expand up? And then when Monday's trading happens, does it still leave equal highs? Well, it might be running those on Tuesday and Wednesday. So what would that be suggesting to you? That your idea about that weekly range expanding on the upside and your bias for being a bullish trader, that might be something you could be probing on Tuesday and Wednesday of that particular week, especially if there's a high impact or medium impact news driver during the London session and or the New York session. So you're blending time and price, and you're also incorporating the narrative idea. You have to have an idea why these markets should be going where they're going. And when you blend all these things together, then you'll have a clearer picture. May not be high resolution in the beginning because you're developing, but eventually over time, you'll have 4K resolution on the days that it matters. It's not an everyday bias. Even though you have a preconceived idea what the bias should be, you may go into the marketplace and see something that completely negates that whole idea. And you have to be flexible with that. Remember, I mentioned that earlier in the video. What does that mean? Not being mad that it didn't give you a setup, or if you missed it, you're not mad about that. Or if you tried something and you got stopped out and you were wrong, you don't get mad about that either. And you don't necessarily abandon the bias. If you take a long and you were expecting a big range on the upside and it creates a down day and stops you out, should you abandon that bias? No, because as I mentioned earlier in the video, if you have a down day when it's underlyingly bullish, many times right after that down candle in a daily chart, you have a really big upside day or a series of up days. So try not to just throw out the idea that if you get it wrong, that your bias is wrong. That's why it's important to be focusing on these higher time frame charts and getting a feel for what they're reaching for. And if you operate in that context, you're going to find that it's not as hard as you think it is right now. But all these things I've given to you here are not trying to complicate bias, but I'm just trying to show you all the factors, and these aren't all of them, but there's other factors that lead to understanding when the bias is bullish or bearish, and for that very day. And the key is understanding that calendar and market structure. And if you understand those and you can see what you're looking for the next draw on liquidity, you can see that there's several ingredients that's necessary for that recipe to deliver bias, at least a meaningful and quote unquote profitable bias, and imitate it, and they can't. Get yourself a journal. You can do it electronically or you can do it with hand, but you want to be able to start capturing an everyday study of bias. And you want to have a record of what you think the bias is going to be for the coming week. And when you do this, What you're saying is the largest magnitude of movement in price is going to be predominantly more to the upside or more to the downside. That's how you want to classify initially when you're learning how to do bias. You want to set the tone with the weekly range, that the majority of the pips will be seen on an up move or a down move. Okay? You're not trying to forecast the closing price. And then what you're going to do is you're going to record every single day on a 15-minute chart, a chart with your annotations, what time of the day it made the low, what time of the day it made a high of the day, and how it worked from the opening and of this architecture right here relative to it being bullish or bearish. And you do that, and you don't ever stop doing it until you know what your bias is going to be and you know how to operate in it. It holds themselves back, everybody. And when you finally let go and just let it happen, have fun doing this. If you're not having fun while you're developing, it's going to be longer too. Fall in love with the number crunching and the back testing. The people that do well at this are the ones that have been passionate with that side of it. You might think, oh, I'm falling in love with hindsight. No, you're falling in love with the process. And then you'll find it going forward, it's just the same stuff. You've seen it enough times. Oh yeah, I've been here before. And then it works. Not all the time, but most of the time.